So what we've seen so far is a strong performance from the Nasdaq Composite. So as it is, Nasdaq is actually up 36% year over year and up 3.3% year to date, even though the year just started. We're just 1 month in pretty much. Meanwhile, the Dow Jones Industrial Average is up 14.1% year over year and up 2.06% year to date. And lastly, the S&P 500 is up 21.06% year over year and up 3.3% year to date. So the performance is tracking very similar to the Nasdaq composite from a year to date standpoint. So what we've noticed is that the market has been rallying based on a stronger than expected Q4 performance from most companies that posted their earnings. The earnings are still being released as we speak, but earnings season actually started last week. And overall, we're seeing a stronger than expected performance across most sectors. So what's important is that the Fed actually meets tomorrow, and we anticipate a a monetary pause at this meeting. And that might not necessarily be gung ho for most investors, but right now, investors are happy for anything that is not a hike at this point because the market has been very tired of the bad news, especially coming from the aggressive hiking cycle in 2022 and 2023. However, the Fed has been on a monetary pause since about July. Now, technology continues to lead the way based on the AI boom or the bull case for AI, especially in enterprises. And the next sector that has been doing very well is consumer discretionary. So those are a lot of retail names. Yeah, American Express, that's a credit card company, the Mastercards of the world, etc., which would have seen a very strong Christmas season. The US economy actually grew 3.3% in Q4, which is much higher than the initial forecast of 2%. So the US economy itself is showing stronger performance than expected, especially coming from consumer spending, which has now fed into earnings, which is now feeding into the market performance. And lastly, in terms of the outlook, the market consensus is for 7 rate cuts from the Fed, but my my opinion is a maximum of 3 because inflation is still sticky, even though it's trending downward. And we also have to factor in the tension from the Red Sea, specifically on how that can affect shipping rates, which affects everything. We've learned that from the pandemic, and also where oil prices could go with an escalation in the conflict between the Gaza and the Israel war.
Yes, Julie, let me ask you. Last week we saw Tesla down some 13%, and there was a big hullabaloo about that. What's your take on Tesla?
Well, I'm going to let down a lot of viewers, but I was never a Tesla bull. I always thought that Elon Musk was a visionary and that he would be able to increase vehicle deliveries and production. But I was always thinking of it from a game theory standpoint. So what Tesla has effectively done is to create a market and a proof of concept for EVs and certain kind of technological innovations like autonomous driving for argument's sake. But the argument is, okay, how long can Tesla keep this up as a market leader? Is it that all the other car manufacturers, which have figured out car manufacturing for so many years, are going to sit on the sidelines? Not necessarily. Companies that have the market intelligence and the experience to know what is economically viable are likely to step in. So the VWs of the world, the Fords of the world, the General Motors of the world, maybe to a lesser extent, and importantly, Toyota. These companies are not going to play dead. So if it is that Tesla has market leadership in these areas of innovation, it's likely that the companies that have been around for so long are likely to come in and adopt and to press forward to keep their market share. And Toyota has gone as far as saying that because of the economics, they're not as quick to shift to EVs as other manufacturers. They're going to keep using internal combustion engines or hybrids for as long as possible because that is what is financially viable. And the infrastructure in in most countries are not suited for EVs, which is why Toyota is slower to switch. So I applaud Tesla for what they have accomplished, but I'm not surprised as it relates to them having issues. I think it's early days yet. I think there's a space for Tesla, but I'm really not surprised. I'm not surprised.
Yes. Let me ask you, closer to home, will we see the markets down locally and very kind of bearish, and the U.S. market, particularly yesterday, I saw the S&P. Do you see investors there kind of looking across the pond and probably switching out, or what do you see there?
You mean local investors going more
Yes,
international, Al?
yes, yes.
Well, to some extent, there might be some investors who have the appetite for that, but
Mhm.
the case can be made that those persons probably would have been looking for US exposure anyway,
Mhm.
because I don't think, I don't think it's either or, because the bull cases are different and they're each
Yes.
valid for different reasons. The US is at a different stage of development. The US has more depth, it has more variety, but many equity investors like to invest in what they know and what they're comfortable with. They like to invest in companies they can drive past every day and say, hey, I'm a shareholder in that entity. So I do think that there is somewhat of a shift because of the difference in performance now. But I think those persons who would have made that switch would have made that switch anyway, even if the JSE wasn't down, because there are two different reasons to love each market because they each have their own merit.
Okay. Can we bring back David? Can we bring it back, David?
Anytime,
I'm right
David.
here. Don't worry.
Okay, Dave. Yes. I wanted to ask you, what was your take? What's your take on Siboney? What's your? How do you see that stock, and how do you see it going forward? And
Well,
that's one question. And my second question, it would be remiss of me if I didn't ask you. We're closing out the first month of the new year. How do you see equities in Jamaica over the next year or so?
so regarding the first question, it's good to see that some Siboney's found a new life. Switching
Yes.
from tourism to, in this case, energy. Just
Mhm.
looking forward to see how these potential future deals that were announced at the AGM are executed by Nigel and the team. But I am not worried about the company being able to execute. It's more so when some of these deals will be transacted. So right now we can see the IEC Wigton joint venture from Wigton's financials. We can get a glance from that. We can see the new deals that are being announced, and we can see the value in those deals. What I'm waiting to see, in a sense, is the next major step forward. So they increase the share capital to unlimited. They reach out to the articles, and they're looking to execute some of these deals later this year. However, how will they execute some of these deals given some constraints? Not just some interest rates, but just market liquidity and sentiment in the local market. I'm not saying they can't achieve these goals that they're planning to do, but it's more so when these goals will be achieved. So Sibani is in a better position, just looking forward to see when things really materialize. I'm not saying that I would wait until I see the first acquisition, but more so concrete, moves that have been made, rather than sit down in a position and be faced with the opportunity cost of waiting in Sibani than find other opportunities in the market and then swinging back after. And then with respect to equities, local equities, I have not looked specifically to see what the performance of the JC index is right now, but from my last recollection, it was down year to date. Tomorrow is end of month, so we're likely to see some equities have a run up in the last couple of minutes. But in terms of the outlook for the rest of the year, it's relatively harder to say. Talking to different CEOs, we've heard, Marlene in the Gleaner about the expected rebound, and you're seeing investors, look for more stable returns in the meantime. So I could see some more mutedness in our local market for the next couple months. I can't speak, to next year as yet because there are just too many variables that happen every second. So, we are hearing of the US planning to deal with the retaliation surrounding the drone strike that happened recently. We're still hearing about the Panama Canal. We're just hearing different things. And if you're on the ground talking to different people, there's a lot less spending. So you would have heard about, Christmas, and Christmas is traditionally a period when money is really spent. But when you speak to businesses, speak to marketing agencies, and everybody else, they said that December was pretty flat. It was not, the gung ho we would have thought it to be. So right now, I'm focusing more so on liquidity. So if I can switch between positions and make gains as needed, I'm fine with that while building a solid long-term portfolio with some of those gains. But my main thing is I'd be sticking to holding on to cash for these that do pop up and take advantage of, you know, those differentials whereby someone needs to get cash and based on their exit, it's in the stock price to a level that I can get a good entry to make a stable profit. And the person going to say it's trading, but the reality is, well, people going to say it's, kind of like swing trading from stock to stock, but the reality is I have to be looking more so at liquidity risk alongside, the potential upside that does exist on the merit of each company. So that's kind of my take on the local equity market.
Okay, thank you very much, David. But I just want to keep you for 1 minute. Javon Russell says there, the thing with Epley, this is to your point earlier, David. The thing with Epley, as you stated earlier, is that it pays only one good dividend per year. The rest are basically minimal. So that's coming from Javon Russell. Thank you, fellas. Thank you, David. Thank you, Julian. And we will see you again next week.